Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's October 10th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So it's October 10th, right? Getting in the middle of October here, but it's October, the month of October. So you know what that means, right? The biggest crashes in history occur in the month of October. The panic of 1907 happened in October, which I bet you some of my retired subscribers may remember. I'm just kidding. I like to play around with them because these are the people that I see the most. They're retired. They go to all the conferences that I attend, that I speak at, and I have fun with them. And they're so honest with me because they're like, Frank, I didn't like that comment, but good stock picks last month. So I like to poke fun at them. But seriously, 1907, right? That panic happened in October. And we have the October 1929 crash, right? So 1929, the big event happened in October where there was several record-breaking slides that actually took place during the month. They nicknamed Black Tuesday, Thursday, Monday. It was just, before there is the real Black Monday, which was 1987. Again, market crashed in October. I'm familiar with this, and that was dubbed the Black Monday. And I'm so familiar with it because it was my dad's claim to fame, right? Where he titled his October 1st newsletter, he titled it Crash. And he said, this crash is going to be worse than the previous three combined. And he got a lot of heat on that because a lot of people did not think the market was going to crash. It's not like today where 1,000 people come on and you got people saying the market's going to go down 75% or it's going to go up 30%. And, back then it was only a good 10, 12 people you listen to on CNBC. My dad happened to be one of them with Navalier, Gabelli, Lane Gazzarelli back then, Jonathan Steinberg. So when he made that call, a lot of people were bullish, and he got a ton of attention because he turned out to be right. The Dow Jones fell 22% in one day. That was on October 19th. And I remember I was young at the time, working in my dad's office in Queens, and it was located on the corner of like a busy intersection. And I think it was like 2 or 3 days later, there was 7 news vans, 7 of them were double parked everywhere because you can't park really in Queens, no spaces. But they were all there to interview my dad. And, it's Queens, New York, and all these trucks and everything. I mean, it looked like the biggest drug bust in history. But it was funny because my dad, the way he dresses, actually not only just dressed, but he actually looks like Rodney Dangerfield, right? And he had a sense of humor. My friends always loved him. So, my brother, my sister, my mom were like, look, you really need to wear something good. You got to go on TV, wear a suit and tie because, I used to wear like these plaid shirts all the time, kind of look like Beetlejuice. So, I'm glad you listened to us, but I'm very familiar with the crash of 87 and how much I learned from that event from my dad, which is incredible because it was nice that I was working then. And he was turning clients away back then too, saying, hey, you know what? Don't use my firm. We're not going to recommend anything. We're in for a tough period. And you never see people do that. And it was something that I respect. And even to this day, I mean, turning down business and saying, hey, your portfolio's fine, or just be careful and not taking on any business because you believe the market's going to crash. You don't really see that from people. They're going to take your assets no matter what because they'll generate fees on it. So it was really cool. But anyway, I'm going to get so much into it, but it's October, and we're looking at a market that has a lot of risks, right? There's a lot of fears. The 10-year surging past 3%. We still have positive economic data that supports Fed tightening, but inflation is definitely rising on, I'm going to say, so many fronts. I mean, where is inflation? Where are we not seeing higher costs? Tuition, electricity, cable, food, energy. I mean, most important, wages. Wages are definitely going higher. Just listen to the conference calls that are going to happen over the next few weeks, and they're going to talk about inflation and wages as it's difficult to hire great talent right now with unemployment rates so low. We're seeing money obviously flow out of technology here. It's pretty meaningful. And you could see the Facebooks, the AMD, tons of momentum names. Those are the ones that outperform the market over the past at least 12 to 18 months, even longer. And where's this cash going to? Well, it's going to utilities. Right? Clear sign investors are nervous. And not just investors, that's institutional money flows. You're seeing it go into utilities. You have home builders hitting 52-week lows. And this could be due to rising interest rates, which usually slow down the pace of new homes being built since they become less affordable. You know the story. We're also seeing prices pull back after an enormous run, especially high-price markets like New York City. Just very high-end prices are coming down, still relatively strong, but it's interesting to see that the home builders, most of them, 52-week lows. We have geopolitical concerns with China, where China's top leaders, they don't care how much their market crashes. They don't seem likely to be given into U.S. demands, Trump demands on the trade front anytime soon, which could basically lead to an all-out trade war. Prices on thousands of products could soar due to tariffs, which are taxes. And I'm not talking about the minor tax increases that have taken place already when it comes to tariffs. It could get a lot worse, which would lead to even more inflation down the line. But more important, what's going to happen is companies, they could pass off a lot of these costs in some of these industries and consumer industries, different industries, not so much utilities and not so much maybe food, consumer staples. It's getting more difficult to pass on those costs and competition and stuff. But companies are able to pass off those higher costs. But I don't know if they're going to be able to pass them off so much longer or too much longer, which could lead to tighter margins or weaker profits. Again, we're priced perfection right now in a market that's at all-time highs. And yes, I know it fell over the past few days, but again, pretty much we're still close to highs in most stocks and the S&P 500. And again, we've seen a nice decline in technology and NASDAQ right now. But I don't think these weaker profits are factored in or tighter margins, especially earnings season, right? The earnings season coming up. Look at our political landscape where a bunch of, I won't call them, but actually I'll say a-holes that don't care about anyone except themselves. I think we all know that. All they care about is gaining power. It's gotten to the point where there's clear hate between the parties, where nothing will ever get done if the Democrats win the elections. And there's no knock on the Democrats. I'm not getting political here. If the Democrats were in control, the Republicans won the elections, I'd say the same thing. But our elected officials will never agree on anything. No matter how much a solution makes sense, they're not going to agree on it. They just, look at the party lines. Look at the Kavanaugh hearings. They really, there's not, on both sides, in between. Forget about what you believe, what you don't believe. Forget about your opinion, because everyone has strong opinions about that, okay? Including myself. But you mean to tell me there's not a couple of Democrats and a couple of Republicans that cross party lines on this? You're basically 100 for 100. It's like all the Republicans voted yes, and all the Democrats voted no. Really? There's not any Democrats that believe like this is a total force, and there's not any Republicans that believe this should be investigated further with FBI. Like, that's how bad it is. That's how bad it is. One of the worst political environments that I ever lived through, where total disregard for doing what's right for the people. And our infrastructure bill is a good example of that. And we need better infrastructure. Our bridges are weak. It needs to be rebuilt. Our water system is horrible. Our dams and everything. And they're just like, whoa, we're not going to come even though they both ran on $1 trillion packages saying this is what we're going to do once we get elected. So you both believe in it, but you really can't come to terms for the people, for the safety of the people. Again, not to get too political. I don't want any, political comments and stuff like that. I know people have very strong opinions, but this is a clear risk to the markets. Probably our biggest threat to the financial markets, more than China, which could be solved, and inflationary threats, which we're going to see coming and things like that. This is like total uncertainty where nothing in Washington is going to get done. It's pretty crazy. Anyways, a lot of risks out there, and I can see why I'm getting so many emails from nervous investors. Definitely makes sense. So here's what I want you to do. Tighten up your stops. You should be doing well. A lot of positions, whether you listen to me or not. The market's, again, still, despite the sell-off over the past couple of days, pretty close to all-time highs. But make a list of companies you would purchase if they fell 15 or 20%. And I guess it's kind of useless, right? Because when you do that and the stock falls 20%, you're just like, I'm not buying it. The stock just fell 20%, right? Because our brains are wired that way. We're not wired to buy low and sell high. Right? We're not wired like that. We're wired to buy the exciting ideas at all-time highs that everybody's talking about, right? Like marijuana right now. I want to buy marijuana. It's so great. Cryptos in January. You look at ETFs. How many sector ETFs come out when the market's great, and then you see them you put in a 3-year chart, 5-year chart, or whatever, and it's just down from them because it's easy to launch these things when the market's excited. Like, who wants a uranium fund right now? Tells you it's time to buy uranium, right? Because nobody has uranium fund. No, everyone hates uranium right now. Anyway, try to buy stocks, or make a list of those stocks that you like that maybe you missed on the way up that you would buy at a 15-20% discount, because you could see that, especially if they miss earnings this earnings season, which is a week away. You want to try to find out, through earnings season, which companies are performing, outperforming, but more important, make a list of those companies that JP Morgan's, the GEs, even not so much that you listen to GE, JP Morgan, but infrastructure companies. And I'll cover this a little bit later in an educational segment, but make a list of companies during this earnings season that are going to give you a global perspective of a lot of different markets, a lot of different sectors. Because you may find some hidden gems in there where Japan's surging right now. A few people are talking about it. China's getting crushed. But let's hear what these companies that do business in Asia are saying, right? That they visit China every month. They talk to the officials there. They talk to the companies. They have operational facilities there. So running lots of operations there. Let's hear from what they have to say, because we know what the media is going to do, inflate crazy stories, right? Because they get paid not to make you money, but for page views. So they're going to have crazy headlines, crazy stuff. But let's see during earnings season, guys. Again, starts next week. You can get a good grasp of what's actually going on, real-time perspective. So pay close attention, because it may lead to not just new ideas, but you may hear something you don't like in a certain sector where you have a big position in one of your stocks, and you might want to get out. And that's happened to me a lot. Not only have I saved money, but maybe just by listening to these conference calls, there's so much information that they give you. And by the way, you can listen to these for free now. You have it's a level playing field when it comes to, you can listen live on the call. You can just go to the company's website. They'll tell you when they're reporting earnings, and then again, this is season's coming up, so it's probably in 2 to 3 weeks. Within 2 to 4 weeks, your company's likely going to report earnings, and after that, it's mostly small caps for like another week or two after that. So it's like a good 3 to 5 weeks of earnings season. But you could just go to their website, and they'll provide data on their site for you, which is really cool, and just say, hey, here's how you listen to the conference call. Here's a dial-in number. Or you can go to free sites like Seek and Alpha that are going to, post the transcripts of these calls a few hours after they finished. Definitely by the next day. And you can learn a lot from this stuff. So like I do every single quarter, as it comes to earnings season, I'm going to bring on one of my favorite guests. His name is John Petrides, Managing Director and Portfolio Manager at Point of View Wealth Management. You've probably seen in numerous financial outlets, about to become a regular on CNBC, which he deserves. John is a regular guest on this podcast and one of the best analysts at breaking down earnings season. That's why I love having him on. He's going to tell you what he's looking for this earnings season, what companies you need to listen to when it comes to the conference calls or reading their transcripts. And of course, as always, he's going to share some of his favorite ideas, which one of his picks we did put in our all-star portfolio, performing very, very well. He's going to tell you what his next pick is and what he likes going forward. In all seriousness, John, awesome analyst. He's all over the networks. And what I love about him is he knows his audience. Where he always explains complicated things so every investor's on the same page. Something I really appreciate, since you know how it is. I mean, sometimes you'll see interviews where an analyst is breaking down a company, on a very technical level, using EBITDA and discounted cash flow analysis. And sometimes it's difficult for individual investors to grasp or understand, where John, really breaks it down. And I love that he did that. And seriously, really, really great interview coming up. Then in my educational segment, I'm going to share a pretty cool strategy with you that's led to some solid returns for me over my career. In short, the strategy allows me to purchase industry-leading companies at an incredible discount, to the point where I significantly reduce my risk, but yet I have the chance to earn triple-digit returns on industry leaders. Now, I'm not talking about options, futures, or some special trading course you need to sign up that you see on TV. Well, my system told me to buy here and sell here, and it tells me to buy, and they show you all the profits that they made. No, it's not one of those. I promise. It's a common sense strategy that anyone could use, but I'm sure most of you actually never will, and I'll explain why that is in a moment. But really good educational segment coming up. Before I get to that, let's break down the coming earnings season with superstar analyst and my good friend John Petrides. John Petrides, thanks so much for coming back on the podcast.
Thanks, Frank, for having me on. Love being on the show.
Well, what a difference a quarter makes, right? Since the last time we spoke on this podcast, basically, I have you on every quarter. We always break down earnings and things like that. Earnings season is upon us, coming very, very soon, shortly. But I'm saying what a difference a quarter makes, because the last time we spoke, you're looking at economic data, everything's positive, everything's all rosy. But right now, we're seeing a lot of cracks, a lot of concerns with the markets right now. Should investors be worried?
Well, I think investors should be diversified. How does that sound? And that's a way to protect against being worried. If your assets are spread out and you can manage your risk accordingly and have your money in different buckets, then I think it diffuses the worry. Listen, we are 3,500 days and counting into this bull market, and we could talk about that. It's a funny conversation, because on the earnings front, on the corporate side, corporate America is continuing to kill it. More than 75% of companies in the S&P 500 beat analyst expectations yet again last quarter. And it wasn't just on the earnings side, it was done on the revenue side, on the top line, which means it's not just from, a lower tax rate and cutting costs and buying back stock to move the earnings needle. It was really done because demand is there. But it's the macro and the headline that has thrown a monkey wrench into, I think, everyday investors' fears, right? The macro data in the U.S. is coming in strong. Ex-U.S. looks fairly weak. The headlines on the political front as we approach the midterms elections has people nervous and worried. The conflict that's brewing between the U.S. and China has people worried. The potential financial contagion that we're seeing starting with Turkey and its currency collapse, spreading into Argentina and their peso collapsing, South Africa, and now today I think it was Pakistan, whose stock market is down 14 or 15% today, and who may have to go hat in hand to the IMF looking for a bailout. So there's fears that there's global contagion happening, and that could derail everything else.
Now, is it just the headline risk? Because we've been, listening and reading stories about China and trade tariffs, and for me, I was telling my investors, look, it's not really a concern. We have very strong earnings over here. It'll impact China more. But to be honest with you, I didn't think it would last this long, and it seems like it's going to get worse before it gets better, right? It doesn't seem like China's going to crack here. It seems like they're going to fight this thing through. Well,
here's the deal, right? In the spring, when trade tariffs started coming to the forum here, and the Trump administration threw out a number of, $200+ billion on potential Chinese goods that could get slapped with a tariff, the market freaked out. And then, the tariffs imposed were smaller numbers, but we built up to that $200 billion. Well, now we're at a point where it's all new territory. Any incremental news that comes to the market between the U.S. and China in trade tariffs is going to cause volatility, because the market hasn't thrown its lasso yet around that data. When the Trump administration threw out at the time that high watermark of $200 billion in tariffs, analysts can say, okay, here's the impact if X, Y, and Z happens, and we get a number on it. Now, if we throw $500 billion, which is essentially, every dollar amount that we import from China on an annualized basis gets taxed, then it changes the whole equation. And the bigger issue is, while the U.S. economy is doing really well and the dollar is strengthening, the global economy, particularly China, is not doing well. The Chinese stock market, I think, is down 20% for the year. Yesterday or over the weekend, the Chinese central bank had to do a form of quantitative easing, where they lowered the reserve requirement ratio for banks, basically made it easier for banks to lend and put more money into the economy. If you're growing supposedly 6.5% GDP, why would you need to stimulate the economy? So, there is definitely concern over there, but we're dealing with two leaders, President Xi in China and President Trump, that are very powerful men, and I don't know, have very big egos, and it's right now turned into a blinking contest, and neither one are budging.
Yeah, it is interesting, because what have we seen so far since all this, nonsense, tariffs and just trade deals and things like that, where, we were able to restructure NAFTA where Canada decided, okay, we're cool with it. And you look at those markets and even Canadian listed stocks went a lot higher. You look at Japan, who's kind of like, okay, working with us, who's agreed. And you're looking at that market, which is kind of like under the radar, but Japan is like amazing right now. I mean, the statistics coming out of there, like housing, I think was at land prices went up for the first time in like 27 years. You've seen the market break out over there. It's just, a story that a lot of people aren't talking about, but it's interesting that, from China's perspective, it looks like, hey, if we work on a deal, and again, it is getting personal and you want to save face, but I'm just surprised behind closed doors, you're not going to work this out because it seems like the countries who do tend to, you have a bottom of the market, turns out to be a great buying opportunity.
I think that's right on everything you said. It's going to be interesting to see if the Chinese do back down, and Trump is playing uncle with them. He's really, flexing his muscles, but the Chinese have a history of, they haven't been a very wealthy nation for a very long time historically, and they're okay with dealing with periods of poverty and declining economic growth and a weaker stock market. I mean, it's just not a very mature economy. There's not much of the population that's even invested into publicly traded stocks. So, it's a lot different than, say, if China was to be imposing this upon the U.S. and how you and I and all of your listeners would be feeling it. It's just a different story.
No, it definitely makes sense. And we're talking about just a macro picture here because, even some of the things that I've heard and people that we've interviewed in the podcast in the past, and even people have emailed me who are manufacturers, people in manufacturing industry have said that they've increased their supply to lock in prices. So you're seeing a lot of manufacturing data, a lot of data go through the roof. It could impact earnings right away, but they're doing that because because of the uncertainty that comes down the road where they don't know what goods are going to see increased taxes on. And you wonder if a lot of those numbers are pushed in now, and maybe they are, and they're going to slow down later. But also, we're going into earnings season, which we talk about all the time. And I have to tell you, even from the few companies that report, it's not really, technically earnings season yet. Maybe next week or whatever. You really get prime time like 2-3 weeks from now. But you're seeing cost inflation as a major, major problem. And I'm not saying that you're looking at companies where they're going to beat on both, but when you look at their guidance, I could see a lot of uncertainty, which I don't know if that's factored in where stock's currently at. What are your thoughts with this earnings season? Because I think this is going to be a really big earnings season, and it's going to catch a lot of people by surprise to the downside, not to the upside for once.
Yeah, I mean, I was nervous heading into last earnings season for a couple of factors, and I continue to be nervous heading into this earnings season for almost the same exact reasons. And historically, Frank, when Alcoa was together as AA was the ticker, that used to be the first Dow component that would kick off earnings season, and everyone would use Alcoa as the barometer to what this upcoming earnings season is going to be. Well, last quarter and this quarter, I view it as Pepsi as being the barometer for earnings. And why do I say that? Pepsi is a global company. And one of my fears to analyst expectations are for about 20% growth year over year for earnings, which is huge. Now, we had that last quarter, and like I said, a huge 3/4 of the companies in the S&P 500 beat analyst expectations, right? So you had a high bar, and they're able to vault over it. Well, the bar is still high, but the pressures to margins haven't gone away. So, for example, Pepsi's a global company. The dollar has been very strong. So my fear was going into the earnings call that foreign exchange and the strong U.S. dollar would hurt Pepsi's earnings. Well, it did. It cost about 2 points of growth to Pepsi's earnings. The second thing is commodity prices. Oil has been above $60 a barrel for the entire year. Gasoline prices have increased. And then although Pepsi didn't break it out, clearly tariffs on aluminum and other commodities could impact company profit margins. And lo and behold, Pepsi called out commodity prices as a pressure on margins. So what happened throughout all of that is they had to lower their future guidance. So the stock was off, I think, 10%. So although they beat for the quarter, they lowered for future guidance because of pressures, macro pressures on their earnings results. And my fear of, again, the strong dollar, strong oil prices, and potentially tariffs, could take some of the shine off of that 20% growth year over year. So maybe we don't grow 20%, maybe we grow 18%, and companies guide down. And as you and I both know, missed expectations and guiding down never spells good things for stock prices. So, that was my fear heading into last quarter, and it's my fear again. The only difference between last quarter and this quarter is more time has been allowed for these pressures to marinate. Now Pepsi has gone a whole 6 months essentially with a stronger U.S. dollar, and a whole year with higher commodity prices, and the effects of the lower tax rate has been baked into the cake, and commodity prices are longer in the tooth, and tariffs are longer in the tooth, and they don't seem to be going away anytime soon. So that starts to get factored in, and unfortunately for analysts, you kind of have to wait because there's so many variables here that you just don't have control over, and you don't have that much foresight into, that you have to sort of let the company report before you can adjust your earnings downward. And I just have a feeling that Pepsi is the barometer for that, and we're going to see more of those types of results throughout the quarter.
Yeah, and you brought up a good point because it is about expectations, right? I mean, when companies report earnings, it's not really what they report because that's over the past 3 months. They could bomb the quarter and raise guidance, and chances are that stock's going to do okay after the quarter. But if it's vice versa, where they blow out the quarter, but say going forward, we have to lower estimates, that stock's probably going to get nailed. And what I think we're seeing here, John, I don't know if you agree with this or not, where, the last couple of quarters, I didn't understand the massive impact that, tax reforms, I understood that earnings, but the massive surge in earnings for all these companies across the board, where it's, they're supposed to grow at 15%, they grew 18%, they're supposed to grow 18%, they grow over 20%. But now a lot of that with the markets at all-time highs, and again, I know we sold off the past few days, but the expectations are built in for stronger earnings. I don't know if the expectations right now are built in for companies, of the uncertainty coming down, where I see a lot of these companies saying, we really don't know the landscape, especially like you said, when it comes to the dollar, right? We saw a surge in the dollar. We don't know what's going on with China right now. And we've seen, massive inflation that I think a lot of people are missing or not talking about because they focus on the CPI, but I just see all this coming together, and it just presents an uncertain picture for me. Usually uncertain is the death of all profits and stocks, right?
Yeah, right, exactly. And I think you're exactly right. The funny thing about the market, and we spoke about this in the past, is, the weight of tech and the FANG stocks are dominating the market. So right now the S&P is trading at about 16 and a half times forward price to earnings multiple. So their price to earnings over the next 12 months, about 16 and a half times. So from a valuation standpoint, that's a little bit higher than where we've been over the last 10, 15, and 20 years. And probably a little bit higher than where we've been over the last 60 years, but nowhere near bubble territory. And the idea is if you backed out or equally weighted, these FANG stocks that dominate the index, the PE multiple, the valuation multiple, actually come down quite considerably. So my point behind that is, without tech and without Amazon, the market is definitely not up, and Netflix, the market is definitely not up as significantly as it is, as strongly as it is year to date. And if you look at other sectors, there's definitely value to be had where a lot of these earnings pressures are already priced in, and you could find some better value. So, it's funny because I've said this for 2 years now. The market is not really the market because of how dominant. I mean, the top 5 companies in the S&P 500 make up, I think, 16 or 17% of the entire index. It's the highest concentration of 5 stocks in the S&P 500, I think, going back to 2004, 2005, something along those lines. It's been a long time. So, you have these handful of stocks on a weighted basis are driving the whole ship. And, when you back that out and you look at other sectors, I do believe a lot of this headline risk is starting to be priced in. I think the expectations, as you say, are lower in other sectors outside of tech and FANG. And, we shouldn't confuse what the S&P 500 is doing, as we say, the market versus all the stocks, and then separate tech, if that makes sense.
No, it definitely makes sense. And I want to get to individual companies here, which is important, because you mentioned Alcoa, how that used to be the barometer, right? It used to be, they used to lead off earnings season. But I just looked at the calendar as when you mentioned that, and they report next Wednesday. And when you look at Monday and Tuesday, most of the major banks are going to report. A lot of big companies like Bank of America. You look at BlackRock reporting, Domino's, Goldman's going to report. Morgan Stanley. This is Monday, Tuesday before Alcoa even reports. United Health, Progressive. So there's a lot of big companies. Is there anything that you look for, specific companies you look for to listen to that give you? Because when I listen to these conference calls, it's not necessarily I'm listening to the conference call because of that company. It's because they cover a lot of different areas. They're usually global, and some of these companies are involved in so many different sectors. It gives me an indication on what's going on throughout the world and different sectors where I could, just find new ideas. But is there anything that you listen to specifically, or specific companies that you look forward to listening to that, it could be a barometer or a gauge of other things that you look at to find new ideas?
Yeah. So clearly, I cited Pepsi, which has become more of a newer company that I'm following, given the variables that I've seen that I'm concerned about. So Pepsi is definitely on that list. JP Morgan, clearly for the bank side. If you're looking in technology on the hardware side, there are two companies. One is Arrow, ARW, and the other is Avnet, AVT. And they are tech distributors. So they will tell you by going through their earnings calls, what's the health and breadth of the technology space? Is money flowing to our consumers spending within the tech area to put new money to work? Think of Arrow and Avnet are almost like Walmart and Target, but for tech companies, right? So Cisco and Hewlett Packard, they take their shopping cart and go to Walmart and Target and they buy stuff off the shelf to make their products. And then the companies putting the stuff on the shelves are the chip players, the hardware guys, that sort of thing. So by listening to those conference calls, that gives me a good indication that I've historically used on what's the health and breadth of the tech sector. You could always look at clearly Exxon and Chevron on the energy side because their asset base is so global. They're going to have, they're not just focused on the Permian in Texas or in the Bakken in Dakota. They have a global asset base. So, I'm always tuned in to those guys. Because they're also going to move the CapEx cycle. If Chevron or Exxon say, hey, we're increasing our capital expenditures, our budget, to do more drilling in X, Y, and Z, well, guess what's going to happen to Halliburton, Baker Hughes, all the drillers, everyone down the supply chain? Those stocks are going to rise because if Exxon and Chevron are spending more money, they got to use those guys to fulfill their budget. So they're the big players for me on the energy space. Disney for me is the big deal on the media side, more so than Amazon or Netflix, because Disney's media library is so vast. They still have cable assets. They have the park, obviously, Disneyland and Disney World, so you can see the health of the consumer. They'll tell you if, what the international attendance is. So clearly, if a strong U.S. dollar is hurting people from, Europe coming to visit the U.S. and Disney World, that's going to impact, that'll be an impact to consumer-related stocks. So Disney's a very good barometer for me across the entire consumer landscape. So those are some companies that I like to keep an eye on, at least for those respective industries, because I listen to those calls because they really do give me a big approach and perspective of what's going on in their respective sectors.
Yeah, it definitely makes sense. I appreciate you giving that list because when we do these interviews now, I mean, we'll go over like a couple of topics that we'll hit on and stuff like that. But I just shoot questions and we just talk like right off the cuff. So right. It's impressive. And I appreciate you saying, no, these are the companies I look for because I know, that you focus on all sectors like me. You're a market junkie. So
exactly.
So I appreciate that. But let's get to individual stocks. So last time you were on, you talked about a company called Bright House Financial, which we put in, we have a product called All-Star Portfolio because I wanted to start really tracking a lot of the companies that my guests were talking about. And we put tight stops on them. So, no one takes big losses. But the reason is because I've seen like so many of my guests recommend so many great stocks and people talk about Bitcoin at 400 and for now we track it. We call it All-Star Portfolio. And the last time you talked about Bright House, we tracked it and it's up about 11-12% for you, which is really good. What are some of the stocks that you're looking at maybe into this earnings season with, it's got interest rates rising? You have, again, a lot of things in the environment. Is it utilities or, is it a conservative approach? What are some of the stocks that you're looking at that make sense right now?
Sure. So I guess, you have to caveat it with, we take typically a longer term approach to investing in a stock. So I appreciate that you throw, stop losses around it, but when we're buying and for our clients' portfolios, we're typically taking, probably a 2 to 3 year at least investment time horizon. So although Bright House is up, I still think there's significant more upside from here. Another name that I like is Bank of America. I wouldn't be surprised if the banks have a poor quarterly result this upcoming earnings season. The yield curve has been flat for most of the quarter. The shorter part of the curve has been higher than, or almost the same as the longer dated. So when banks are paying people out of their CDs, they're not able to make a big difference versus the loans that they're making. So maybe you see the banks unleash a lot of capital and buy back a lot of stock or something along those lines to mask what I think could be a weak quarter for the banks. But I would definitely use it as a buying opportunity. I like Bank of America personally, and some of our certain clients of our firm own Bank of America. So I think that's a really good stock to buy. I would buy it at today's prices, but off of a poor earnings results, and you get it at a better price, I would definitely buy Bank of America. On the tech side.
Why, before you get to the tech side, I wanted to ask you a question now, because this is going to be great for our listeners. Now, why Bank of America when you could say the same case for most of the large banks? Maybe Citigroup has more global exposure and people might be a little more negative on it. I kind of like Citigroup because I think it's priced in, but JP Morgan might be a little bit more expensive. But what makes you look at Bank of America instead of, JP Morgan, Wells, or other large banks?
So I think you hit the nail right on the head. We love JP Morgan. JP Morgan is a holding in certain client portfolios here. It's just a valuation call that I think within the banking sector, there's better value to be had. I still think Wells Fargo has customer service issues that it's working through, and, it still gets a premium valuation that, I just don't think I don't have to deal with that at Bank of America at this point in time. If there's any more ghosts that continue to be coming out of the closet for Wells Fargo, right now there's nothing present in Bank of America. I rode Citigroup for a very long time. I pitched that on this show, I think maybe 2 years ago or so, and I think you're right. I still like Citigroup. I have no issue there. But if I had to pick one of the banks that I like, it is Bank of America because it doesn't have the international exposure at this point in time. So I could deal with just the U.S. economy, of which is really, really healthy at this point in time. And I know with a 3.7% unemployment rate that by and large, the loans that Bank of America have made are getting paid back. So, and the company is flush with cash. Here we are, Frank, 10 years post the crisis, right? And I'm pitching Bank of America. So
yeah,
this should show you how far we've come.
And it's about
valuation is excessive.
And it's about making money, right? I mean, some people will look at it and say, how could you do that after the credit crisis? And they use everybody's money and they got bailout taxpayer dollars. Listen, I think all of us agree that, we're really ticked off of the banks as well, and how selfish they were, but they needed to get bailed out, and now again, it's about making money, right? It's not about saying, "Well, we love Bank of America; they're doing the right thing" and stuff like that. But because of the laws in place, the 4 or 5 major banks are just they're huge now. They're monstrous, and they're going to get bigger. And earnings, again, they're free from. They probably risk free. You say interest rates go higher, lower. I mean, they're able to hedge themselves so much in different markets and different tools and stuff like that. But it is interesting that you said that. But I know that you wanted to talk about technology too.
The valuation of Bank of America is not excessive, in my opinion. So, if I was able to get JP Morgan at a cheaper price at a better valuation, I would. Here, I feel like I get that exposure through Bank of America without having to pay up for it. So that's what makes it attractive for me.
And guys, I mean, Bank of America's trading at 10 times forward earnings. We're looking at a market that's trading around 17 times forward earnings, the market in general. Again, most bank stocks, I think, are trading probably about 12, I've had, I guess, 12 times earnings. So it does seem like it's trading at a discount to the rest of the market. Now, I know that you mentioned technology as well, that you were going to give us a pick. And I appreciate you going through like how you picked Bank of America instead of just, hey, banks are going to do great. I like Bank of America. I know investors really appreciate it and listeners do.
Yeah, no worries. And the other name that I like is Lam Research. LRCX, Lam Research. The stock is maybe $150 now. It was $230 at one point earlier in the year. And LRCX is a is it LRCX, is really a cash flow machine. So what do? They are the leading 144. So the stock has gotten destroyed year to date. I mean, it's 52-week high with $235. So the stock is really cheap from a valuation standpoint. A near 3% dividend. Management is taking 50% of their free cash flow, I think, over the next 5 years, and they're returning that to shareholders at a minimum through dividend, and they're buying back massive amounts of stock. So what does Lam Research do? They're essentially the leading provider of etching and cleaning and the services for the chip guys. So it's kind of like Intel, or Taiwan Semiconductor, who's one of their larger clients, make their job is to make chips. They buy the equipment from Lam Research to do etching and do the specifics around building the chip, cleaning, and there's all of these processes there. Lam Research bought Novellus maybe 7 or 8 years ago. They tried to buy another company, but it was blocked because of monopolistic fears. So they're the dominant player in this space. So what's happened? There's fear. This is clearly a cyclical company, and they're tied to the chip cycle. And there's fear that there is overbuilding of chips because there's massive demand of, artificial intelligence and AR, augmented reality and Internet of Things and all of these buzzwords, Frank, and trends that we talk about in the tech space. And you've seen a lot of that start to play out. And the fear that the stock is going to go lower because of the chip cycle has too much supply, and you're at the point of the cycle where you have to work through that supply. Plus, the tariffs on Chinese goods doesn't help. And I would assume this recent fear of the Chinese, there's rumors of the Chinese, planting chips on U.S. goods to spy on companies. That's not good for the chip tech space. So, and I don't know what to make of that. No one has come out really and spoke about it. Maybe we'll find out more in earnings calls of who was involved in this. I don't know what to make of that whole fear, but you wrap all those things together, and Lam Research stock is down a lot. But this company generates a tremendous amount of free cash flow. And they're at the point where they're returning a lot of it to shareholders. They are the dominant player. It's just they're working through a certain point in the chip cycle, which it's just nature of the beast when you deal with this industry. But if you're bullish on AI and all of these trends that we're seeing in the tech world, I do believe that Lam Research is one way to play it.
No, it is interesting too. Cheap company returning 20% back to shareholders and profits and things. Yeah, it's these guys are huge. And look, there's a lot of warnings about how the chip sector is slowing, but we just saw Taiwan Semi come out, I think today or yesterday, and say that, sales for September are up 10%, which is a blowout number for them. But it's just interesting. Right. There may be leading orders for Apple's, products that we just launched and things like that. But it is interesting to see because right now in the chip sector, there is like a fight between bulls and bears, and drastic reports, like from Morgan Stanley, I think, saying that the chip sector is, it's that cycle is starting to die, starting to slow down. Others say, no, it's still here, like AI and things like that. But that is an interesting stock, Lam Research. Now,
I mean, it just the pendulum has swung really quickly. From where a year ago this time we were talking about, the emergence of every trend under the sun for tech, and you needed Lam Research to go through it, to now where an overabundance of chips. And now the pendulum is completely on the other side, that the market is just flooded with all this stuff, and companies buying Lam Research type equipment to make chips is just going to slow because you just don't need it because your stockpile of chips on your shelf, which could very well be. Again, I'm not looking at Lam Research for the next quarter. I'm thinking about 2 or 3 years from now, and if the trends in tech continue the way I think they will, I think this company, with the amount of free cash flow they generate, is still going to be in a dominant position, and I think there's attractive value in the stock here.
No, and guys, just like you said, I mean, it's $144, and you might say, "Wow, $145." It's all about percentages, guys. I mean, if the stock goes up 20%, it doesn't matter if you have one share or it's $100 or $1.50. But it was $234 is a 52-week high. So the stock is down a lot, factoring a lot of those risks and paying a good yield. So I want to finish with this because this is important, because you do lots of media appearances all over the networks and financial media. But you're getting a spot on CNBC that you talked about that is going to be pretty cool. Could you talk about it a little bit? This way people could actually see you, because I know I get some comments saying, yeah, I saw John on TV and stuff like that, but it seems like the CNBC thing might be a little bit of a big deal.
I appreciate that, Fred. Yeah, so I'm going to be on CNBC at the closing bell on October 16th, commenting on Netflix earnings, and then on October 30th, commenting on Facebook's earnings, which are obviously two mega stocks that the world is, overly focused on right now. And I'm excited for the opportunity. We have certain clients that I don't own either of those stocks. Not buying them for clients. I'm not particularly excited about either of those stocks right now. Another leg down on Facebook, maybe becomes a bit more interesting. I would expect Facebook to have another leg down. The amount of, the last thing Facebook could possibly have happen heading into the midterm elections is that there are rumors of, tampering in the midterm elections. So I would presume heading into the midterms that Facebook is hiring an army of people to scour the data to make sure that their product is as clean as possible. I mean, we saw what happened yesterday with Google shutting down its Facebook Plus product because hundreds of thousands of users' data was compromised, and they didn't tell anybody about it. So this issue of privacy is not going away, and I'm not excited about Facebook's upcoming earnings. Netflix, on the other side, the market focuses on one thing, and that's subscriber growth. The stock sold off tremendously after a huge run last quarter because their subscriber growth was slightly below expectation. Because the market knows that if subscriber growth comes in less than forecasted, then the bear case roars really loud. And what's the bear case? Netflix is hemorrhaging cash flow. They're buying all of their content. Trying to replace content is really hard to do. I mean, Netflix clearly killed it at the Emmy Awards. They've won many top honors on many of their shows. But if they can't get more subscribers, then it's a house of cards. And you find out they have stuck with a lot of debt, and they're burning through cash flow. Valuation's really high, and all of a sudden the emperor has no clothes. So it's all going to be about the subscriber growth for Netflix, as it is every quarter. That's the one metric that investors focus on.
Yeah, and John, I got to tell you one thing. Make sure you know Facebook inside and out, because I have a feeling that they're going to miss the quarter really bad. I mean, they make the most money on these political ads, which they basically shut down. They changed their whole method, and people are still confused how to do it. How to actually place ads and stuff, and the whole approval process. They just got compromised again with their data, but they missed earnings badly last quarter, and the stock fell and then came back a little bit. Now it's starting to trail down, but when you look at the analysts, I was looking at 41 analysts cover the stock. I think it got 2 downgrades, and everyone was like, "Oh, don't worry." But like the estimates didn't come down, and that's what surprised me. Where I'm like, you look at a fundamental change in their business model, and now you go into political season where they usually kill it, and they're not really taking these kinds of ads anymore. It's going to be interesting to see how they make their numbers. I don't know how they're going to make their numbers because expectations is just still sky high. I think there's still like 37 of the 41 analysts still have buy ratings, and they're basically 190 plus to 230, 240 are the price targets on that, and none of that has come down yet, which surprised me. So it should be. It's not like Intel where everybody lowered their estimates. Expectations are low. Expectations are sky high for Facebook. I'm going to be very surprised if they do beat and that stock goes higher from here. But it's that's going to be a nice call to be on. And by the way, real quick before I go, once you start doing this segment and you're on all the time, don't forget about us little guys like me in this podcast. Come on, pal, right?
This is my favorite show to do out of all the media appearances. This is the best one. So you and I, doing a brain dump and talking about what's going on in the world. It's not 30 seconds in the Shark Tank where they throw in chum and you go and beat each other up. So
yeah, it's a lot different medium. So listen, John, as always, I really appreciate it coming out of the podcast. And real quick, if someone wants to learn more about you, read about some of the stuff that you're writing, how can they do that?
Yeah, thanks, Frank. So I'm with Point View Wealth Management. We're based out of Summit, New Jersey. Our website is ptview.com, www.ptview.com. We have started over the summer a webinar series. And it's a mixture of financial planning topics and some market commentary stuff. We do once a month, so feel free to go onto the website, sign up for the upcoming conferences and the webinars, and that's where you can find a lot of information. It's all free access. Any of our commentaries, our newsletters, or market commentaries, feel free to read them and shoot me a note if you have any questions.
All right, you got it, buddy. Take care, man.
Thanks a lot, Frank.
Okay, it's great stuff from John. I love the companies that he told you to listen to for earnings season. Not so much where it's for that specific company, but they're just so large and so diversified that you can get a good grasp of what's going on in different sectors like Arrow and Avnet Technology. I would throw Taiwan Semi in there as well. It manufactures chips for almost all the biggest chip companies in the world, outside of a few. Disney, he brought up with, the parks when it comes to consumer spending, the health of the consumer. I think Walmart, Target you could throw in there, but also Disney when it comes to media and media ad spending and stuff like that. For me, personally, I like to listen to infrastructure companies. I mean, Fluor, GE, I would throw in there, Vulcan, Martin Marietta. These are companies that are very diversified. They talk about different geographies. They operate across many sectors and then give you a good indication on certain markets, again, positive and negatives. But I love listening to those. They show you, where demand is, what sectors are seeing demand in, what they're looking to push into, what countries are doing good, which ones are doing bad or poorly. So those are great companies. When it comes to financial industry, Bank of America, JP Morgan are obvious, as well as Goldman Sachs. I mean, good indication of what's going on since, the richest people in the world, have accounts at Goldman Sachs, and they know how they're spending, their spending patterns, what are they looking to do, what are they looking to get into, inflows, outflows, and stuff like that. Very, very important. Amazon, Microsoft, Google. I mean, get great technology companies. Again, diversify. You can hear so many different industries through those. He brought up great oil companies as well, but also what I like, even, natural gas / oil is Devon. And I would listen to ExxonMobil, Chevron, obviously, but Pioneer, EOG. I think these are the largest shale plays in the world. These are like majors when it comes to shale. So they're going to tell you how businesses, are they increasing spending? Because they've been very careful during this rise in oil, and they just went through a horrible period, which is going to lead me to my educational sector. But, these are companies, United Healthcare as well, CVX Health for healthcare industry. But these are the companies that I look for that give me a good gauge on what's going on with the overall economy, not just in America, but globally. And also will give you a good indication of a lot of different sectors and help you find new ideas, and also could help you, lower your exposure in some areas based on what these guys are actually saying. Now, I always say this about all my guests. I love John, but this podcast is about you, not about me. So let me know what you thought. Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. Now, let's get to my educational segment. And to me, it was one of the biggest bubbles that I ever see, probably in the history of the stock market. Okay, now I'm talking about sectors here when I'm going to get into this. Okay, I'm not talking about the whole entire market collapsing, because everything does bad at once. I'm talking about sectors. So when you're looking between 1995, 2000, technology stocks exploded. I mean, you look at the value of the NASDAQ went up, what was it, 400%? It went from 1,000 to 5,000. Again, it's from 1995 to 2000. We all know why, right? The commercialization of the internet, new products and services like easy-to-use web browsers. It was, the computer prices fell, allowing it to scale where everybody started buying personal computers. You had faster speeds, and then throwing smartphones there and allowed almost anyone to surf the internet. So it was a massive explosion, and new companies just started popping up like crazy to take advantage of the incredible boom. Just like we see in crypto, like all industries, 3D printing, all kinds of industries when things are really hot. AI as well, something more recent. But back then, most attached .com to their name, since this was the easiest way to raise tons of capital. And if you're looking early 2000, remember, what hit the fan in March 2000, but early 2000, and most .com companies trading at all-time highs. These are guys that, some paid millions on new facilities, just tons of employees. They also, I think it was 16 .com companies that paid around $2 million to advertise the 30-second spot on a Super Bowl. I mean, it gets basically chump change at the time, right? A lot of these companies had billion-dollar valuations. I mean, it was crazy, crazy times. Now, I'm not sure if you remember it or not for people out there, or if you're millennial, but if you were even the people that lived during this time, I mean, companies would come out with their IPO, and they would come out immediately, not like today where they wait like Uber and Facebook, and when 80%, Alibaba, when 80% of the growth is gone and all the venture capitalists made their money, then they sell them to everybody else. Like, they came out right away. I mean, these companies had like 5 pages, web pages, and some of the links didn't work. And on the day of the IPO, the stock would pop like 70, 80%. And people, it would open up 70% higher. People would buy it like crazy. It'd be up 200-300% by the end of the day. By the end of the week, it was up 400-500%. And everybody would just pour into any IPO that had .com at the end of it. It was pretty crazy. It was kind of amazing when you think about it. Then we know what happened, right? .coms are just, I think they were trading over 100 times earnings leading up to that, and definitely over 40 times like right before the crash. It was March 2000, the bubble burst. And NASDAQ fell 10% to close out that month, 10%. By the end of April, the next month, the index was down 25%. And by November, talk about what, 8-9 months later, most .coms were down 75%, wiping out close to $2 trillion in capital. Again, just about 8-9 months. So when everybody goes to that period, they look at the pets.com, the webvan.com, the etoys.com, and they talk about how many companies went bankrupt and no longer exist, like those 3 companies I just mentioned. You're looking at the 16 company, I think it was like 6 or 7 that had that took out Super Bowl commercials, went bankrupt within 12 months, which is pretty crazy, right? Hey, I have Super Bowl commercials, $2 million. Your company doesn't even exist. That's how crazy it was back then, the spending. But we're all programmed to focus on, wow, the negatives and the bust period. But for investors, there's a valuable lesson that gets overlooked during these extreme times. And I'm talking about when it comes to sectors. And it's one that could help you generate exceptional returns without taking on much risk. Because when you look at different sectors, a lot of these guys get crushed, but going back to technology, we're looking from a period from 2000 to 2003, which was disaster, and you saw all these bankruptcies, but also what happened? Let's look at the positives. The .coms that survived became industry leaders. The Amazons, the Pricelines, the eBays. They weathered the storm. And after the tech bust, what happened? They got smarter about operations. They weren't dumb and just spent money like, recklessly, didn't care. They focused on things like return on investment, cash flow generation, balance sheet improvements. And what did that allow? Well, as the years progressed, kept going further and further out, this allowed them to acquire smaller competitors. They increased spending on research and development, not just marketing. So the research and development led them to new technologies. And you're looking at Amazon, Microsoft getting into cloud, Amazon getting into cloud, getting into smart homes and things like that. This helped them increase their competitive advantages. And if you bought any of these companies after the fact, after that sector collapse, even 2001, 2, or 3, pick your time period. In 2001, you may say, a little bit early, 2002, a little bit early, but even 2003, whatever, you're probably sitting on a small fortune today. Now, those survivors, a lot of times, if they get smarter, become industry leaders, So my point is this, whether it's oil, solar, utility, you go through every sector, semis, defense, chemicals, infrastructure, so everything. Every single one of these sectors goes through extreme times. it's a nature of business, right? Think of the crypto, which is the most recent example. Before that, again, you could highlight 3D printing or oil. But during this boom, what happens to companies? They always look to expand because everybody wants to see growth. Their investors want to see growth all the time, which, never happens all the time. You can't grow forever. But they're looking to expand, so they hire more employees, they spend more, they take on more debt to fuel this growth. And, almost every single time they end up getting ahead of themselves. So the sector usually corrects, destroying the weaker players, but the survivors that get past through this period prosper. And these survivors, a lot of time, can be bought at dirt cheap prices. So why? Because it's going through a complete washout. Investors hate the industry. They hate every single stock. They're looking to get out. It's on Wall Street trading floors, this stage is known as puking. That's it. Everything is done. It's like the kitchen sink. And a lot of times you'll see like really great companies, like look at oil. You're looking at Chevron, like 2015, right? So 2014, 2015, when that massive collapse happened in prices. But a lot of companies in 2015 was the worst year for them because a lot of their hedges came off. So they were hedged oil at much higher prices. So they were still generating profits as oils fell from 100 to 60 to 40. But, once they really started going below 60 and as time progressed, they had, those hedges, have a time limit on them. And once they run out, now to hedge, you're going to have to hedge at, instead of $80, $85 a barrel. Now, you're hedging close to where spot is. So, which is 60, 55, 40. And that's when you saw a lot of the oil companies get crushed. But if you're looking at Chevron, just buying like in 2015, it was $75. It's $126 today. Devon was 19 in early 2016. It's 39 today. I mean, look at Cameco. Cameco's probably a pretty good buy today at $12. I bet you a few years from now, you'll be happy. You could say, well, Frank, I thought that was the case a year or two ago. Again, we saw Cameco come down. The uranium bear market has been absolutely terrible. And you're right. It's not a foolproof strategy. But I will say this. When it comes to these industries, what a lot of times that we do as investors is we want to maximize our returns, regardless of risk. So what we do, like say when we see gold prices come down, gold's a good sector to talk about, we want to buy the junior miners. And the junior miners are the most risky stocks because when this cycle turns, these are the ones that are going to go up the most. But if the cycle doesn't turn, these are the ones that get nailed the hardest. Okay. So these are some of the stocks that I've had in that we stopped out in my Curzio Venture Opportunities portfolio because I thought the risk reward is very favorable. And, I was willing to take on 35% of risk because if the cycle changes, and I thought over the last 2 years, it would definitely change, especially over the last 9 months or so, where it didn't change and these stocks continue to sell off. Even though gold is kind of trading at the same price they traded in 2013. It's kind of weird. Yet most of these stocks down 60, 70%. But instead of going after in gold and going after the juniors, right? Which again, if the market turns, you're going to make a fortune on the worst stocks. Usually the worst ones go the highest during bull markets. But right now, especially when it comes to gold, like uranium, we just gave you an example. Cameco is the leader in the space that you could buy at dirt cheap valuations and hold long term. But look at the gold companies, and not just, we've seen a lot of royalty companies do pretty well, despite, gold is just, a horrible sector right now. But if you look at the biggest gold companies and what they've done over the past few years and delivered, you're going to find some really great opportunities to the point where they can still produce if gold falls 10, 15% from these levels. That's how much they lowered their prices, their all-in costs. They sold off a lot of non-core projects, did deals with royalty companies, this way they bring in cash flow. Some of these companies are paying dividend, raising their dividend. But before you're jumping into those crazy, juniors, which we do because we take, our Curzio Venture Opportunity newsletter is more about risks. You're taking on, a lot of risk to hit grand slams, right? So you're going to have to take on that risk. But as, individual investors, look at the bigger players in this space, especially in gold. I mean, these are companies that, low risk right now, because even if gold prices come down, they're still going to be able to generate profits, right? They're producers and their oil costs are lower. A lot of these guys delevered, so that they're sitting on a lot of liquidity, able to, so prices do come down, they can expand their portfolio and buy great projects at dirt cheap prices from competitors that are struggling. But it is an industry where, and if gold prices stay at these levels, they're printing money right now, a lot of the majors. And not only that, if we do get that cycle change, that's when you can get triple digit returns on these companies because they're so cheap and out of favor right now. It's a good way to invest in industries. But instead, when you see these sectors and every one of them goes through tough times, don't focus on the risky ones that might look attractive, 60, 70%. Again, for me, I do that in my Curzio Venture portfolio. But for Curzio Research Advisory, you're going to get an interesting write-up today. It's going to be on a gold pick. Yes, I said gold, but read it first before you dismiss it and go crazy and think I'm nuts. Because I didn't know the fundamentals of a lot of these majors were this great. I was just on the assumption that they were still delevered because they all went nuts in 2011, 12 and spent like crazy, right? Did stupid things just like companies do during big growth markets, growth periods. But now when you look at these companies and what they've done over the past few years, they're very solid. Their foundation is great. They're leaner than ever. And if the market stays the same, they're going to continue. A lot of these guys are raising their dividend right now. They're generating huge cash flow, got amazing projects. So, from a risk reward perspective, and that's important to understand, risk adjusted, we say in our language on Wall Street, based on your risk adjusted, it's, you're looking at the majors or the gold majors, pretty good buys right now. Because I don't think you're going to see a lot of risk because they're down already. They're already generating profits, generating dividends, going to start buying back stock probably because their balance sheets are that good. But if this cycle turns and when it turns, which I think it will as interest rates go higher, don't shoot me, gold investors. I know what you're going to say. Well, interest rates go higher, and that means people are going to, go into other investments that pay interest, and gold doesn't pay interest, so it's usually better in a negative interest rate environment. Well, if that's the case, then why has gold been horrible for the last five years when real interest rates are negative? So that's not the case. So when interest rates go higher, what happens? It's going to take some of that spunk right out of the market, where we've seen why invest in gold when you could buy Amazon and get 15% a month on average, right? I mean, that's the way the market is right now. Maybe not the past week, but there's no reason to buy gold until you're a little nervous, until there's a shift taking place in the market. And we're starting to see that because higher interest rates are probably going to take some steam out of this bull market. It may fall a little bit. And I think you're going to see money transition, which we're seeing into utilities, but also into a lot of majors when it comes to gold. So as interest rates go higher, I think that could be the catalyst that fuels gold prices. Again, I understand that goes against conventional wisdom, especially of your longtime bull, crazy bear guys, whatever. But there's just the market's just so powerful right now, the U.S. market, that it just doesn't make sense for investors to even touch gold. It's just not worth it to them. And I think once you see this market come down, again, it's been a 9-10 year bull market in stocks, like 8-9 years actually. I think once this market does come down, you're going to see money come out and look for alternatives. And right now you're looking at majors and gold and a lot of these royalties as well at premium valuations. And I bet you that's going to make gold prices go higher, or at least this cycle change or turn over the next 6 to 12 months. Let's see if I'm right again. Even if it doesn't turn, buying these majors, you're still going to be okay. And even if prices come down, they're going to use their cash hoards to buy amazing projects to increase and expand their portfolio of high-grade gold projects. And again, they're profitable. Most of the majors at around 1,000, 1,050, some 950, which is a 15% decline in gold prices from right now. So based on risk reward, they're just really, really good opportunities. And that's one sector that I do like. So hopefully I didn't talk too much during that educational segment, but I had a lot to say. I just wanted to show you guys how to make money in this, when sectors do collapse, because you don't have to take on a ton of risk. Sometimes you could buy the majors right in front of you and offers you triple-digit returns with much, much lower risk. Okay, guys, if you're interested in a free tariff report, it's on our website at CurzioResearch.com. It's a great 20-page report on the important and not so important things you need to know when it comes to a possible trade war with China. And also, I share some free picks with you. Talk about one name that I really love that I believe has 3 times to 5 times even more upside potential as China gets more serious about having a full-out trade war with the U.S. And it looks like that's the course and that's what's going to happen, especially leading into 2019. We'll see. But again, all that's for free. If you want, you can go to my website to get that free report at www.CurzioResearch.com. Okay, guys, that's it for me. Any questions or comments, again, feel free to email me anytime. And thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.